Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
When I was a kid, thinking about real estate and participating in real estate, even before I knew what I was doing, I never thought I'd be getting hopped up for accountant episodes on real estate. But here we are, 2024, and these type of episodes really do it for me. And the reason why is because I'm a disaster when it comes to getting my taxes in order, maximizing the tax consequences of my investment. I don't know why. My dad was great at it. I'm not. This episode is going to help you if you're just like me. My guest is Thomas Castelli of Hall CPA. He's going to tell you about reducing taxes and building wealth proactively. Let's go. This is episode 115 of Zen and the Art of Real Estate Investing with my guest, Thomas Castelli. Thomas is an accountant with Hall CPA. He helps real estate investors and business owners reduce taxes and build wealth. I know you think that sounds easy, but it's not easy. He's also the founder of New Babylon Capital, a holding company for his investments. Thomas, welcome to the show.
Thanks for having me, Jonathan. Honored to be here today with you.
Yeah, I'm excited to talk to you. We were just talking about in the pre-call, and I was joking that there's no amount of tax episodes that can't help people. Do you agree with that?
Yeah, no, I have to agree with that. Real estate tax is very in depth, so there's always more to talk about.
Yeah, and I think most investors are used to general accountants, which I've talked about before, which seem like, oh, sure, they're going to get my taxes done, but that doesn't mean they're going to maximize real estate investment benefits and long-term cycles of what you want to do with in your investments. Is that kind of where you found your niche along the way as an accountant?
Yeah, it really was like kind of twofold for us. It was the focus on real estate tax, which is something that not many people dive deep into, and also combined with the fact that we give tax advice, proactive tax advice and planning to actually help people reduce taxes, whereas most CPAs, especially generalists, tend to just file your tax return, give you your forms, send you on your way, and that's about it. They'll see you next year. So those two things have been where our niche is.
Yeah, I realized a long time ago that I would, maybe 20 years ago, I'd have an accountant who would just say, oh, well, send me what you've done. And I just send them like whatever paperwork I had, and somehow my taxes would get done. Yeah. And then I'd think, well, I mean, I probably could have had a lot of deductions and things that I could have done. I wasn't really involved in the discussion. Do you feel like a lot of investors are kind of detached from taxes? I know they all wait too long. I know that.
Yeah. Yeah, I think a lot of investors are because, while it's a necessary part of your business, it's certainly not the most exciting part of the business for sure. It's very tedious, compliance oriented. So I think a lot of investors tend to neglect it or, put it off to your point. But what I found is that thanks to the world of the internet, podcasts, things like that, people are starting to get more educated on it, starting to realize what is available to them and taking action towards being more proactive on the tax side for sure.
Yeah, I agree with that. And as much as I complain about a lot of the junk on social media, I really do think in fields that wouldn't traditionally be associated with, outbound social media marketing, no one would have thought, 15 years ago, hey, accountants are going to crush it on social media. But I really agree with you. I think that just opening up those discussions just for investors or even newer investors and saying, oh, okay, I'm not maximizing what I can do. Everybody wants to keep more money and then set themselves up for later, right?
Absolutely.
Do you feel like if you had to choose between the two, do you find that investors, at least that you work with, are more lackluster keeping the books? This could be both, or more lackluster planning those investments for the future?
That's a great question. I think bookkeeping, I'm going to give the slight edge to it because it's a tedious, repetitive task that most entrepreneurial people just don't want to do. And it is a cost to get it done, whether you outsource it to like a freelancer or a part-time bookkeeper or an accounting firm. That is one of the things that we often have to nudge investors to take care of because it does actually help you not only reduce your taxes to make sure, because you're actually capitalizing on all the deductions you have. You could do better tax planning, but also helps you make better financial decisions. So we do see that. I'd say people are probably, a little bit more proactive on their investment side, but that's not too far behind bookkeeping, I'd have to say.
Yeah. And I mean, the more units, the more tax consequences. So as people scale up, that's when they really need to dig in. On the first one, you can get away with some things. Maybe you're not maximizing, right. You're not going to be at a big loss. But when you're looking at depreciation over, a bunch of different multifamilies, there's a lot of options there.
Absolutely. There's a lot, especially the bigger the properties, the bigger your investments, the more tax advantages there are for you. There's also the more risk that you get it wrong if you don't do the right thing, just because the numbers are so large. So,
yeah. And I have found that you can undo some stuff by having a pro kind of look at what you've done in the past, but you can't undo every mistake that you've made. It just doesn't work like that.
Yeah. My experience, it's best to be proactive whenever you can. And if you see things, like Stephen Covey says, start with the end in mind. If you know where you're going, what you want, what your goals are, that allows you to be more proactive. And if you get with a CPA or tax professional sooner, the better usually. So.
Yeah. When was the first time that you were interested just in real estate as an entity?
Yeah, I'd have to say probably back in like 2012. So I was going to college to become an accountant. And I kind of realized along that way that probably wasn't going to get me truly to where I wanted to be. So I started picking up books. Rich Dad, Poor Dad was one of the first ones. And the rabbit hole went pretty deep from there. So I started attending different meetings and networking events. And I eventually met a group of people who were doing a 3-day weekend on real estate syndication. So I went to their 3-day weekend, learned the entire business from A to Z, kind of through that like crash course, if you will, and really fell in love with that business model. So started attending their monthly meetings. And that's how I kind of got involved, eventually made my first LP investment. And then a mentor from that group ended up saying, hey, if you find a deal, we'll syndicate it. So started banging the phones, networking with brokers. Long story short, someone ended up sending me a deal that penciled out. We ended up syndicating it. So that's kind of how I got into real estate. And that was around between 2012 to around 2015. All that transpired. And then really by 2015, I was in the game.
Yeah. Is there some benefit that you were looking at in your mind as a tax consequence to syndications as opposed to just buying your own multifamilies?
Yeah. Believe it or not, tax wasn't the first thing on my mind when I was looking at this.
Well, you read Rich Dad Poor Dad, so you're like in go mode. Like, I want to get some stuff. This is there. Yeah.
And I saw it was just the ability to build a lot of wealth through real estate. And syndication, for me, the reason why I think that maybe hit a nerve is, I was a young guy and I didn't have much capital. So I was like, okay, great. I can go raise money and we can get these deals done. And that's how I can get my foot in the game. So that's kind of what motivated me to do it. I'd say the tax benefits were maybe what piqued my interest into real estate to begin with. But I can't say that had a specific impact on syndication versus otherwise.
Yeah, you were looking for a wealth builder outside of being an accountant, right?
Right, exactly.
Yeah, I think that's important for everybody. I think I found over, all these interviews that a lot of people hear the advice early, like get out of your job, but your job is what pays the bills. It's trying to find what is going to be the long-term thing as a side to your job, right?
Right. No, absolutely. What I found is that there's one thing that ultimately happens for most people. You have an income source that ends up funding your real estate investments. And for some people, that's a job or a business that they're running outside of real estate. And perhaps that's the best place for them to be because that's where that's where their expertise are, their network, so on and so forth. And then there's other people who are all in on real estate, but usually that system still exists. Either they're flipping properties, they're wholesaling, they're doing BRRRR, or they're syndicating. And that activeness provides the income to fund the long-term investment portfolio. I kind of said it in a nutshell, but that's typically how it works. You have some form of income generator that then allows you to fund the long-term investments.
Yeah. And I think people are, rightfully trying to figure out when that income then equals, from passive into what they were making. But then that doesn't mean that it's still the right time to go. You're an expert in your employment. You're still learning and investing. So I think that's always been a hard thing. But also maximizing the taxes on the properties that you own and using depreciation correctly can help you get there quicker. Is that fair to say? And I think I know from my own personal experience, I'm a complete failure at that. I just don't like taxes. I feel like it's exactly like you said before. One, I know I'm going to have to pay a bunch of money. And two, I don't really want to go through the minutia. I just want someone to just read my mind and figure out where all the stuff is supposed to go, which means have a bookkeeper.
Right. No, absolutely. I think just by being in the game of real estate and starting to invest in rental real estate specifically, you're putting yourself in a good position from a tax perspective because, to your point, depreciation, which is a non-cash expense, can help shield your rental income from tax, despite the fact that you might be generating positive cash flow. So you could be putting money, cash into your pocket and telling the IRS that you have a loss. Right. And that means you're not paying tax on your rental income. So you already have a more tax advantaged stream versus, say, earned income, which is generated from a job or a business. You're typically paying up to 30%, 7% for tax at the federal level. In some cases, self-employment tax or FICA taxes if you have a job, and then state taxes. It's not the most efficient source of income and very difficult to shelter. Whereas real estate is easier to shelter. So just by being in real estate, you're putting yourself in a good position. I will say one more thing here is that even if you're looking to ways to reduce taxes on your earned income, real estate can be the way to do that as well.
Right. It's a conduit to take away some of the gains that you have in something else. That's why depreciation is so important.
Yeah. No, very, very powerful expense that is not exclusive to real estate, but it's very impactful for real estate investors.
Yeah, just as a side note, what are some of the other things that people buy basically as intentional depreciation? I've seen it as airplanes, large scale cars, things that you can kind of depreciate all at once to offset income.
Yeah, no, cars are the biggest ones, trucks, SUVs, those are very common amongst business owners and real estate investors alike. I'd say that also there's other investments you can make outside of real estate, such as ATM machines. They're depreciated over 5 years and they're eligible for bonus depreciation. So, and usually in the ATMs, there's no salvage value. So there's no recapture of that depreciation, unlike real estate. So ATMs are a big one. I've seen car washes, self-storage, certain types of fitness centers, depending on how they're structured. If you're actually buying the equipment, that could be one. Also car rental businesses, if like Toro, for example.
Oh, really?
If you buy a few cars, they're all going to be used for business. You could depreciate those as well. And depending on the car, if it's like a truck or SUV has a gross vehicle weight rating of over 6,000 pounds, it's going to be eligible for bonus depreciation, which could be quite, substantial for reducing taxes.
Yeah, you're saying a lot of things, and all I'm hearing is that I need to finish the build on my Rivian. I just have to finish the build. It's big. It seems like I can depreciate it. It's electric. I'm going to get a tax break. It seems like a smart move. When investors come to you, what's the first thing that you try to do with them? Are you trying to figure out where their entire portfolio is? Because unless you know everything, it's very hard for you to give them the best tax advice, right?
Yeah. So when investors come looking to work with us, we typically do like an initial consultation where we kind of learn a little bit about their situation and what they're looking for help with, and if we can even help them to begin with. And if we can help with them and we do end up working with them, we typically go through a 45-day planning process where we actually do a deep dive into their current portfolio, income streams, tax situation, really kind of get a thorough idea of where they are today and then where they're looking to go. And then from there, we outline a number of strategies. So the first thing we do is kind of, can we even help you in the first place? And second, if we can help you, then we need to know as much about your situation, not only what you've gone today, but where you're looking to go. The further out, the more clear investors are on what they're trying to do over the next, say, 3 years and even beyond that, the more we can help them. So we do spend a good amount of time trying to figure out everything you have going on. That's usually one of the first steps.
Yeah, that makes sense. Yeah, I just feel like, again, my own personal experience, a lot of people will just come to you, dump all the stuff on the table and say, here, can you fix this? But they forget that they have other things kind of cooking in the pot as well.
Yeah, I mean, we definitely have people who RMS. Just to be upfront, there's definitely people
talking about me now.
No, I'm sorry, and we do help sort that out too. But yeah, usually we try to start with the planning, just because that's where we're going to have the most impact. Filing the tax returns is certainly important. Obviously, it's government requirements, but and penalties for not adhering to those. But we kind of look at that as the necessary evil, and really where we see the real value being at is being able to say, hey, if you do X, Y, and Z, you're going to reduce your taxes by $10,000, $20,000, $30,000 this year, so on and so forth.
Yeah, there is a way to review someone's last couple of years and then file adjustments in case they just kind of were not doing a good job or had a non-real estate friendly accountant.
Yeah, absolutely. That's something we do as part of that review process. We do look at prior year tax returns. And if there are issues that can be resolved as substantial issues, we would recommend doing an amendment. Sometimes things can't be resolved in the past, though. So then it's like, okay, well, let's make sure this doesn't happen in the future. that's really where the education and consulting comes in to help investors make sure they don't make those same mistakes going forward.
Yeah, I've said this before, and I want to get your take on this. I think a lot of people look to people who are handling their money as kind of ancillary, like, hey, I'm going to, hire Thomas, he's going to do my taxes, instead of looking at it like we're all involved in a big partnership, everybody pushing real estate inside my sphere. We're all trying to work together. Is that something that you work on to try to get, everything together? Just like we were saying, I just feel like investors can be cagey and they're trying sometimes to, they make their tax returns look better, but then it reduces their buying power. This is something you have to unpack by turning it into a partnership. Yeah,
that's very interesting. From like a partnership like between the client and us. So we try to be that quote unquote partner with our clients. We do encourage them to share information with us. Like if you're going to sell a property, the sooner we're aware of it, the sooner we can help you plan for it. If you're going to be acquiring certain properties or certain vehicles and things like that, the more you keep that open dialogue with your CPA, the more they're going to be able to help you proactive. One thing I did notice, though, it's interesting, is some, not all, but some investors tend to look at their CPAs as like IRS compliance officers. And to an extent, that's a fair assessment because some CPAs certainly act like the compliance police.
Yeah.
And they're kind of guarded with the information they share. But while we do have responsibilities as professionals, we very much are on the side of the client, and we want to help you use the tax code. We want to help you use what's available to your advantage to actually reduce your taxes and pay. I'm hesitant to say as little as possible because sometimes not every single strategy is worth the return on hassle, right? It's not worth the effort, but we want to help. We're definitely on the side of the clients and helping them reduce taxes.
Yeah, I've always found that it really is that. Like the code is there for a reason. A lot of it is friendly for real estate investors, but you need someone to help guide you through. And that is, of course, being compliant to the code, but it's using the code as it was intended, which your general accountant just maybe doesn't know about because it's not their specialty.
Yeah, absolutely. I mean, we've seen a lot of generalist accountants just get basic, what we believe is basic real estate stuff wrong. Like we've had generalist CPAs tell their investors they can't use bonus depreciation, or they can't use cost segregation studies, or they can't qualify for certain tax elections they might be eligible for. Really, out of I think their ignorance of how it works for the most part, or their fear of like coming back to the compliance officer. I almost feel like some CPAs are very much almost like you're saving too much money. Like you can't do this because it's like, no, if this is what the tax code says. The Congress and the people who wrote these laws, the lawmakers, put these rules in place to incentivize certain actions. And it just so happens to be that real estate's one of those areas or one of those businesses, whatever you want to look at it, where it's a necessary part of society and the economy. And the government wants to incentivize people to build housing, to provide housing via rentals to various parties. And the way they do that's through the tax code.
Yeah. And I've always, everybody's always worried about this alleged audit possibility. But I mean, if you're working with a professional and you've properly categorized everything, an audit is annoying, but it should still be easily verifiable if you have everything in order and you're working together. An audit's terrible if you have everything in a shoebox like the old days. That's not going to be great.
Yeah, audits are painful no matter what. But like to your point, if you are well organized, you have your bookkeeping up to date. You've been following the rules. You're doing everything as close to by the book as you possibly can. Usually, audits can be pretty painless. I think where a lot of people see a lot of pain in audits is to your point when you have the shoebox full of receipts and you have to start digging through the substantiation for everything, or you're not keeping proper records in other places. Like, for example, there's something called the real estate professional status, which requires you to keep a time log. It doesn't require you to keep a time log, but time log's often the best source of substantiation. And if you have those things together, the audit can be very easy for you. But without this stuff, it becomes painful.
Yeah. I mean, that seems like one that they might want to take a look at, the 750 hours. Where are you getting them from? I mean, it should be easy. You should have it logged. If not, it probably will be a problem.
Right. Yeah. And that's one of the biggest, there's like over 500 tax court cases on that status. And repeatedly, when you review these, I don't know how many, but repeatedly you see they lost because they did not have proper substantiation. It's like probably the number one reason. So, it's just keeping books and records. And I know it's tedious, but if you want to take advantage of some of these more powerful aspects of the tax code, sometimes it does require a little bit more administrative effort, but it could be quite powerful. So often the juice is worth the squeeze in those areas.
Yeah. And I mean, I'm just guessing, but I would think that there's a decent percentage of people who go for this real estate professional status that are doing it as a hack. So they are, there are people like, if you're going to do it and do it the right way, you want the 750 hours. It's just going to make you better and better and better as you go. But I can see people using it as a hack and just trying to cobble together the hours. And that's tough.
Yeah. I mean, the real estate professional status was put in place in 1994 as a way for full-time real estate investors effectively to be able to use the losses from their rentals, from the rental properties to offset their other sources of income. And that's how it was designed. So 750 hours and more than half your total working time is the requirement to meet the real estate professional status. And what you see is a lot of high income earners, they see their tax bills go through the roof and they're starting to say, how can I reduce my taxes? And you know what's really interesting about the real estate professional status on the tax return? It's a simple box. Just check the box. So like if you ever fill out it on tax software, and, like something like TurboTax, for example, and you make that, you click that button, if you will, and you see your tax slide, you see your taxes just drop, and you're like, okay, let me just go forward with it. So it's very easy to check that box in most cases, but it's not so easy to actually defend that position if you did not actually do the work and have the records. So I understand why it's a hack for some people, but if you, it's very powerful if you take it seriously. So.
Yeah, I could see someone checking it, seeing the tax benefits and being like, yes, but not knowing like an alarm's going off somewhere in the IRS. Like, hey, does somebody else just click the box? Like we need to check this out ASAP.
Yeah, audit rates are pretty low, knock on wood, in general. But we do see audits from the real estate professional status. And interestingly, a lot of people come to us when they are in the middle of the audit. Like, if I could give anybody any advice about audits, if you receive that notice in the mail, the first thing you should be doing is picking up your phone promptly. Like not waiting. And if the notice says it's due January 31st, you need a response. And don't wait until January 20th, ideally to make that phone call. Pick up the phone, talk to your CPA, talk to your tax professional, and start getting that ball rolling sooner rather than later. You're going to save yourself a lot of hassle, headaches, and time, and you probably put yourself in the best position to win that audit by doing that rather than procrastinating or trying to go it alone.
Yeah. Hey, this is Jonathan. Thanks for listening to another episode of Zen and the Art of Real Estate Investing. On this brief interlude, I wanted to tell you that we have a mailing list. I actually don't love mailing lists. There's so much. This is not an automated mailing list where you get on a drip campaign. These are written once a month, will eventually be at once a week again by me direct, and they're not spammy. So if you want to sign up for our mailing list, you can go to bit.ly/streamlined with a D mail. Bit.ly is bit.ly/streamlined mail. See you there. Let's swing over to your investments a little bit. So you've become comfortable now with LP syndications after you did one syndication as a GP, correct?
Yeah. So I actually made my first investment as an LP. I want to say it was a 60-unit apartment complex in Columbus, but it might have been less units. But nonetheless, I made that investment, saw the money come in after making it, and was like, okay, how can I get on the active side, right? Then we ended up syndicating 82-unit apartment complex in Florida. And I found a deal, brought it to the table. We did the whole deal. And by then I was like, okay, this is legit. Like this is real. And then from there, just a lot of work doing it on the active side. I'm not discouraging anybody from doing it. It's just, we had so much stuff going on here at the firm and the business that I was like, okay, let me just pivot back to LPs, be the passive investor. So that's kind of what kept me in the passive bucket right now.
Yeah. I mean, an active versus passive, it is. It's how much time you have available to do it. And you don't want to be active and not have the time. But what do you find beneficial for the passive? Obviously, I guess for me, when I'm looking at syndications, I'm looking at the operator. And honestly, after all my years in real estate, I just invested in my first syndication last month. And now I'm looking at it saying, I should have done this before. I'm trusting the operator. I know him. I think the returns are going to be good. And I've looked at other previous returns. Is that something that you see, I guess, investors who are looking for a little bit of a time away from the active side going to?
Absolutely. So for me, what kind of got me into the LP side was maybe two things primarily was higher returns than you get in the stock market. So most of the LP investments I've been a part of have been like 15% plus, 15 to 20%, somewhere around there. So it's better than what you can get in the stock market. And it's also tax advantaged. So if you're investing in the stock market, for example, outside of your retirement accounts, you're going to have dividend income, capital gains. And even though they're taxed at a lower rate than, say, 37%, they're still very difficult to shelter. Whereas, again, real estate, thanks to depreciation, you're able to shelter the income. So it's a combination of the higher returns in the stock market and the ability to shelter the income. To your point, one of my biggest things whenever I look at a syndication now is who is the operator, who is the sponsor, what is their track record? Do they have repeat investors? Do they have references they could provide? Really doing the due diligence on the sponsor is key. And if you find the sponsors who are high quality, there's a lot of them out there. You sometimes have to uncover some rocks sometimes to find them. And then from there, once you get comfortable from that, it's really smooth sailing for the most part. It really is, it's all about the operator at the end of the day.
Yeah. I'm really more and more interested at the older I get, just because I don't really enjoy I've never liked being a landlord. I was a landlord my whole life. My dad was a landlord. He taught me to be a landlord, but the actual I love the properties, and I like getting everything set, but I don't want to hear about the water heater. That's just, I'm not good at that. I just don't want to do that. So I think every investor is kind of learning what's better for them. Like you said, it was a time thing too. Things were getting busy at work. So being a GP, you don't want to fall flat as a GP, because that's, as an LP, like you're looking at the GP to make sure that everything's always taken care of.
No, absolutely. There's a return on your time, right? For sure. And, if you can get a 15 to, like, I think one of the deals that I was in, I think I had like a 24% return, internal rate of return. And you're looking at, 15 to 24%. That's pretty good. And really, at that point, what you're doing is just making the decision to pull the trigger and wire the money for really at the end of the day. And that's the extent of your involvement. And you have to weigh that against, like, how much returns can you get doing it yourself? What is the delta? Is the delta really that high? Like, if it is, then maybe you should go active, maybe, right? But so oftentimes, what I'm trying to say is I found that the returns are sometimes comparable to what you can get on the active side, and you don't have to do a lot of the work, which is what attracts me to being on the LP side.
Yeah. And I guess on the syndication side, there's also syndications for accredited investors and then non-accredited investors. Those are accredited investors going to be an option for somebody who's got a little bit more money hanging around, right?
Yeah. So accredited investors, I give everybody a secret tip on how to qualify in a second. But basically, to qualify as an accredited investor, you typically need to have $200,000 of income for the last 2 years, with the expectation of making it in the third year. And if you're married, that jumps to 300. You can do it single or combined, or you need to have a net worth of $1 million, excluding your primary residence. And that's the traditional way to qualify. Now, I think at the end of 2020, the SEC updated some rules where if you held certain financial licenses, like the Series 6.5, which you can do by yourself, test is relatively simple, and you actually open up a practice, which is a pain to do, but you could do it, you will actually be an accredited investor. So that's how I became accredited. I went and did that process. That's how I initially became accredited. Now, the SEC is going to be creating a test that if you pass this test, you'll become accredited. So that was something that it's under development. So, that's kind of how you become accredited. And usually, I want to say usually the best investments are on the accredited side, because the best sponsors usually established. They have machines and the systems, and for them to go and invest, and basically the Rule 506C allows them to advertise online, so on and so forth. But they can only take on accredited investors. So for that reason, they'll typically do the 506C. So becoming an accredited investor can open up a lot of opportunities for you. And the best thing is now you don't even need the income requirements to get there if you take some of these alternative routes.
Yeah. And I think that the size of the investments in accredited deals are just higher. When it's non-accredited, you're going to have a lot of people who are, testing it out, rightfully so, but you'll have a lot more investments at smaller value.
which again, still add up to the same thing, but I still like to see more people putting more money in.
Yeah, having being on the syndication side, kind of seeing behind the scenes, dealing with investors can be interesting. Let me just say that, because you'll have certain investors who've been doing this for a long time, investing in deals, and they'll just wire you the money, and you won't hear from them again. Then you have the smaller investors, particularly, maybe it's their first investment, or maybe it's a substantial amount of the money they have, and they're not only are they investing lower amounts, but they're also the most needy from the standpoint of investor relations. And I'm not saying that sponsors should not be transparent and should not support their investors. They absolutely should, and the best sponsors do. But just seeing it from the other angle, it's just like you would typically rather have somebody invest 150K, 200K, whatever, and you're not going to hear from them again, versus having somebody invest 25K and you're going to hear from them every other week. What's going on with the property? What's this?
Yeah,
it's interesting. It's interesting.
Yeah, you've just described the difference between good and bad short-term rental guests as a side note. It's the ones who book, show up, never call you, write a 5-star review, and then the people who immediately are asking questions before decline those right away.
Yeah.
It's just too much. When you started raising money, what was the hardest part about that? Because you did it for the first time for that syndication, and sometimes that's awkward or harder for people to get going.
Yeah, absolutely. So that was a challenging part. So we had a few partners in that deal, and my responsibility was to bring the deal. I brought the deal to the table, and we were all kind of sharing that responsibility to raise capital, but it wasn't my primary. So, what I did was I went out. So I was 25 years old at this time when I was doing this. So I didn't have much of a reputation or experience in this. So I went out and went to networking events and banged the guns and all that stuff, trying to make this happen, doing presentations and pitches. And that ultimately fell short. And so the other partners whose responsibility was to actually raise the capital also somewhat fell short. So what we ended up doing at the time is we went to a crowdfunding company, and they ended up taking part of the deal and raising, I'd say probably about half of the capital for it, which was a good thing. We were able to get the deal done, but they also took part of the acquisition fees and part of the back end fees you get as a sponsor. So I would say a lot of people say, well, if you have the investments, the investors will come. And I would say to an extent that's true, but you need to be out there. You need to have a runway, right? You need to be out there letting people know that you're doing this. You need to have people who are serious about investing. Like I would say, if you're going to syndicate, you want to get that investor engine going now, like right now, if you're going to do it. And then eventually you'll be able to, people will know you in the space. And when you do have a deal, they'll be more likely to invest rather than you putting a deal under contract and saying, oh, crap, now I have to go and do this all from scratch. It's not the recommended path. I can't recommend it.
Yeah, I think find the deal, the money will come applies much more to one-off flips for wholesalers. You're going to be able to find somebody if the deal's good, but when you're talking about 100 units and you don't know anyone and you haven't operated in the syndication space, it's a very tight space. It's why people, you invest with one syndicator and then the deal goes well, and then you just say, well, what's your next deal? Sure, exactly. Maybe they're not going to hit a home run on every one, but it's very unlikely you're going to lose if the first deal went great, and you're evaluating the prospectus and everything along the way.
Yeah, no, absolutely. Usually, and that's the way a lot of these bigger shops do it. What they do is they go out, they do their deals, they get success, and then they just have their investors repeat. So, I know there's one group that went out and did huge marketing campaigns, did networking events, all of this stuff. They generated their investor list, and now they don't do that anymore. They have their investors that fund their deals, and the word of mouth, now referrals, all kind of just works for them. So I guess what I'm trying to say here, it is a big push in the beginning to get this going. But if you do it well, you're going to have repeat investors, because to your point, once you find a sponsor that performs well, you're just going to be like, well, what's your next deal? Let's just keep going.
Yeah, exactly. And much better to have a smaller group with a waiting list than always going into your sixth syndication, still looking for new investors, because they're going to wonder why you're still looking for new investors.
Yeah. It's interesting. A lot of the successful syndicators that I speak to say, if you want to get in on my next deal, you have to join the list now, because I'm telling you right now that once we open up the funding period, the funding window, we're going to be oversubscribed within a matter of days, if not a week or something like that. So it's like, that's how you have a good sponsor, when there's people chomping at the bit to get into the next deal.
Yeah. I really think vetting the prior deals is important. Of course, it's a piece of paper or another prospectus that you can look at, a PDF download, which people can get good with AI now and create something, but you really have to, you've built trust along the way, you back it up with the data, and then you try out a deal. And I think, would you agree though? I mean, with syndications, to make a decent amount of return that you want, you're usually trying to put in a decent amount of money. But I still think going into your first one, you have to think, if I lose this, it's on me. I made a bad decision on the operator. And if you think like that, you maybe have a better time going through it.
Yeah. No, I'd have to agree with that. Like, you're not going to maybe hit the home run, right, the first time with the operator, and you're going to take a learning lesson. What can I do better picking operators going forward? What I will say is that if there's anybody out there listening to who wants to get into the LP game, there are communities out there. One of them is Left Field Investors, for example, where they have forums, private forums. You pay for a yearly membership, relatively inexpensive. And what they do is they vet all these sponsors. So you go on there and you'll see a list of sponsors that don't invest with these sponsors because of all these horror stories, or, hey, look at all these sponsors who performed well for all these other investors over the years. And I wouldn't say blindly follow that. You still definitely want to do your own due diligence on the sponsor, on the specific deal, review the prospectus and everything. But that can help you find a pool of quality syndicators or sponsors to start vetting rather than having to kind of do it from scratch. So that's a quick tip that helped me a lot.
Yeah, I think that's really important. There's a lot of shiny objects out there. So being able to cut through that mess and into a forum where everybody, hopefully has the same goals, definitely going to be helpful. Kicking it back to the tax perspective, is there one mistake that you see a lot of investors doing more often than not that you have to fix that maybe we can help somebody not make right now?
Yeah, absolutely. I'm going to say this. If you're an active investor, or even if you're a passive investor, do not put rental properties, whether that's you're buying it directly or syndications, into an S corporation. And the reason for this is that you could own 100% of the S corporation, meaning you're the sole owner, but it's a separate entity than you. And what that means, and with S corporations, if you were to say you put a rental property, and I'll give you a quick anecdote. We had a client put a rental property in an S corporation like 1995. This property then appreciated substantially by 2020 something, right? And if they needed to remove the property from the S corporation for financing purposes, and to remove the property from the S corporation, it's treated as a sale, even if you're just moving it to another entity you own. So this group, they were looking at a almost 7-figure capital gain that they would have to pay tax on simply for restructuring it. And there's other issues that come up, basis issues, little things with S corporations. So in general, if you can avoid it, and often you can, don't put a rental property in S corporation. And don't panic if you do already have one in there. Probably be fine. Just don't do it going forward, because again, if you ever need to restructure, and you could need to restructure for financing purposes, for estate planning purposes, for asset protection, for any number of reasons that could come up in the future, that could trigger a taxable event for you. So if I could give one piece of advice, one mistake to avoid, don't put rental properties in S corporations.
Yeah. And like you said, in case you do, just tell your accountant right away so you can plan the way out, or, formulate a strategy around having it in there that will eventually not give you the burden, like you just said, a 7-figure tax bill.
Yeah. It's not the end of the world, but it's just like, at the very least, it can prevent you from doing it going forward, because it can become messy. And we've explored all different ways to try to get it out without having a major tax event. And it's usually not possible. So.
Yeah. And it's not really necessary. I mean, I don't know why it would be necessary to put it into an S corp.
Yeah, what it is, and I'm not an attorney, so I can't give legal advice, of course, but attorneys often recommend it because it's the S corporation has said to have better asset protection properties. Yeah. But the reality of the situation is
you're going to get the piercing the corporate veil speech.
Yeah, you get all of that. And I've spoken to a lot of attorneys about this, and they've all said you could do it with a single member LLC or multi-member LLC. There's which are more appropriate from a tax perspective too, by the way. And It's just like there's other ways to go about doing it. So just like you need a real estate CPA, you need a real estate attorney, right? You need someone who understands it from a legal aspect as well, because oftentimes that recommendation comes from an attorney. So.
Yeah. And that's important, though, to have everybody, like we were saying before, working as partners. If your attorney and your real estate and your accountant don't talk about the real estate, there's probably a problem. If you're the conduit and you don't really know which one you're doing, and they're both trying to show off, which is, again, I'm an attorney, so much more favored on the attorney side, trying to show off. But that can happen. They're trying to be, hey, I'm going to protect your asset, but they're not thinking about the tax consequences. So you really need to get a whole team eventually on board so you can kind of slingshot the stuff between everybody.
No, 100%. And specifically when you get into like partnerships, there's, the operating agreement, and part of that is legal. Of course, it's largely legal. Like I would imagine, I would say, but the tax aspects of that operating agreement, and by collaborating with you and your attorney and your CPA, you can make sure that operating agreement reflects the tax structure that you want it to have, and the allocations and whatnot. So collaborating is definitely important for sure.
Yeah. And like we were saying before, it's silly to think that every accountant knows, real estate investing and the tax consequences, or every attorney, even if they're involved in real estate, understands the full tax consequences, because they don't know about your other properties. So if you guys are working on a plan, you're going to depreciate one, and they're doing something that may affect that. Everybody needs to know. I can definitely see that being a problem if everyone's not, talking and on the same page.
Oh yeah, no, for sure. That's part of the issue if not everybody's synced up. But also too, I think you mentioned, not every attorney or not every CPA is going to be well versed in real estate. It's like it's like a doctor. You go to your general practitioner, your family physician, and they say, okay, you have like a rash or whatever. You need to go see a dermatologist, or okay, you have a heart issue. You're going to go see a heart surgeon, or whatever the case is, a cardiologist. But it's kind of like that in real estate too. Not everybody is, not every CPA, not every attorney, et cetera, are well versed in real estate. So
yeah. This is a question I haven't asked any other accountants, but I think it may help some newer investors. For somebody who's doing their first flip, what should they be looking at from a tax consequences in terms of how they're documenting everything that they're doing? Because a lot goes down on a flip. Somebody goes and picks something up, you send them a Zelle. There's just a lot of moving parts. What's the best way to make sure that you're at least tax friendly on a flip?
Yeah, so a flip is a lot interesting. Okay, so flips. So first thing I'd say, make sure you have a good bookkeeping system in place, because a lot of the stuff you mentioned, Zells, Venmos, what have you, can be tracked relatively efficiently with a bookkeeping system. There's a lot of options out there. The one we see used most often is QuickBooks Online. So making sure you have a good bookkeeping system in place and getting your financial records organized, definitely important. Second thing I'd say, from flips are a little bit different than rental properties. And true flips are considered inventory. So when you sell that flip, you're taxed at your ordinary income rates and typically subject to self-employment taxes, unlike a rental property that maybe you're facing capital gains rates. So I would say that for a flip, to keep it tax friendly, I would actually recommend most people in general start off with like a single member LLC or a multi-member LLC tax as a partnership if you're doing it with partners. But that will actually allow you, and this is going to sound interesting, to make an S corp election. Now, I just said don't put rental properties in an S corporation, right? You don't want to do that. But if you're going to be flipping the property, buying it, rehabbing it, and flipping it, that S corporation can actually help you mitigate the self-employment tax. So you're paying 15.3% on your earned income. And I forgot the exact 2024 rate, but it's up to like $160,000 in income. So you can actually mitigate that exposure, 15.3%, by having an S corporation, paying yourself a salary. You're only paying the self-employment tax on the salary, whereas the distributions, the profits, you're not paying it. So that's another big tool for flippers. And I'd say you want that flexibility, but you may not want the S corporation right away, especially if you're starting out. So starting off with that LLC gives you that flexibility.
Yeah, that was a really good one. I think people are going to be like, wait, I was a no on S corps. Now I'm a yes. It's rental, no. Flip, yes. Right?
Yeah. Because the flips is you're buying and you're planning to sell it. Like, so that selling it or removing it usually speaking isn't an issue. Whereas with a rental property, you're actually buy and hold. That is where the S corporation become problematic. So different tools for different styles of business, but I just hope everybody understands that this is a distinction. Flipping properties, buying and selling, wholesaling, S corporation is cool.
Yeah.
Rental property, usually not so much.
Yeah. All right. One more question before we get ready to wind this down. I've seen this a lot. We've seen people who come to us on my on-market business and they're ready to buy a house. And then, we send them to a lender and they send them their taxes, and they intentionally have their taxes at an extremely low income rate, and they think that's great.
Yeah.
That substantially affects your buying power. How do you counsel someone as an accountant when they're saying, hey, I want to save the money now, but they don't realize they're going to have absolutely no buying power when they show zero income 2 years in a row? No taxes, but can't buy anything.
Oh, yeah, no, absolutely. I missed that before. I remember you said that. So it depends on the lender that you're working with. Most lenders who understand real estate, they'll typically add back the depreciation. So look at your tax return and say, okay, well, this loss was really generated by this huge depreciation expense. When, we know that depreciation is really not true expense, if you will. And we're going to add that back, and that's how we're going to factor into your income. So oftentimes, at least in my experience, finding lenders who understand the game of real estate will typically help. It will be much easier to navigate these lending waters, if you will. But it's really when you have the lenders who don't understand that. And oftentimes, that can be resolved with a phone call, right? Okay, hey, let's walk through and understand what this really means here. And that can be resolved. So my advice there, and what I've seen solve this many times, is just finding a lender who understands real estate. And oftentimes, you're putting yourself in a much better position. Now, that's if the losses are generated substantially by depreciation. Now, on the other side of it, if you're buying vehicles and you're making all these year-end expenses at the end of the year, I'm going to deduct all this stuff, and you're actually outflowing money out of your pocket every year. That's when things become problematic, because now you actually are spending the cash away, right? That's a different story. But if it's largely by depreciation, we found that most lenders who understand the space, that's usually a non-issue.
Yeah. And I found that last part, hopefully this isn't you listeners, but that last part is generally people who they know what their tax amount generally is going to be, and they want to get it off the books because they already spent it. But they have the money to buy a vehicle, depreciate it right away. So they end up with much less taxes. But, there's always a robbing Peter to pay Paul situation. It's going to come back at some point later. Again, which goes back to what we said in the beginning. You want to have a whole plan, and open dialogue with your CPA. So you're really looking at what you want to do in advance, instead of, in December saying, hey, what type of helicopter can I buy now?
Yeah.
We've seen depreciation. Yeah. Awesome. Thomas, where is the best place for people to get in touch with you? Is it at your website, which is thomascastelli.com?
Yeah. So that's probably the best place, to get in touch with me overall. I am on social media, getting really active this year on Twitter, or X as it's now called, at Thomas Castelli.
Don't make that mistake. Yeah.
Yeah. You don't want to kick you off. Okay. Yeah. But yeah, Thomas Castelli _ is probably will be most active. But other than that, thomascastelli.com is where you can find more information, request a consultation if that's something you're interested in. So,
yeah, and you work with investors all over the country.
Yeah, so we're in all 50 states at this point. So we've seen it all. We have a great team, great research software, everything. So we're well positioned to work with a lot of wherever you are in the states.
Awesome. Well, Thomas, it's been a pleasure. Thanks for bringing more tax knowledge. Like we said at the beginning, you can never have enough tax knowledge. And you definitely hit on a bunch of stuff that we haven't talked about. So I'm really excited about that for the listeners. I appreciate you swinging by.
Yeah, no, absolutely. Thanks for having me on. It's great talk.
Absolutely. That was Thomas Castelli. I'm Jonathan Green. We'll see you next episode. I hope you enjoyed that episode of Zen and the Art of Real Estate Investing with me, Jonathan Green, and I just want to remind you, and this is always an uncomfortable part, I don't want you to think that I'm begging for you to like, subscribe, follow, do whatever you have to do for the podcast, leave a 5-star review. But if you like the podcast and you think it adds value in the real estate investing sphere, then just do me a personal favor. Like the podcast, follow it, share it when you can with your friends, and be so kind as to write a 5-star review if you believe it deserves a 5-star review up against what else is out there. I would really appreciate it, and I hope you keep listening.